Hello and welcome to Why Design. I'm your host Chris White and today I'm joined by Damon Bonser, founder and CEO of the British Design Fund. Damon's one of those rare people who's seen product innovation from every angle. Founder, operator, investor and champion in UK design and manufacturing. Before launching the British Design Fund in 2016, Damon built and scaled his own design and manufacturing business, launching over 400 SKUs and setting up operations across the UK, US and Asia. That hands-on experience means he knows exactly how tough it is to get physical products off the ground, and it shaped how he supports founders today. Since setting up the fund, Damon and his team have backed over 40 early-stage hardware ventures, offering not just capital, but also guidance on design, supply chains, and go-to-market strategy. In this episode, we unpack what investors are really looking for in a physical product startup, why so many founders fall short when it comes to cash flow planning, and how the UK can take the lead in reshoring and sustainable manufacturing. If you're building or thinking about building a product business, this one's packed full with useful insight. So let's get into it. Damon, welcome to the podcast.
Thank you.
So I'm going to do my best to do an intro now. This is the cringiest bit of the podcast, and it all gets easier from here, I promise you. We've obviously met a few times in real life at networking events and various different kind of client functions, but I'm so grateful for you to spend the time with me today. I hope I do justice with this intro, but we'll give it a go. So Damon, you spent your career championing British innovation. Your journey spans entrepreneurship, investment and product development, making you a key figure in the hardware startup ecosystem. Before launching the British Design Fund in 2016, you built and led multiple design and manufacturing businesses, giving you first-hand experience of what it takes to scale a product company from the ground up. You understand the challenges founders face, not just in developing great products, but in securing investment, navigating supply chains, and building commercially successful businesses. Through the British Design Fund, you and your team have backed over 40 product-based startups, helping them navigate investment, manufacturing, and commercialization. But beyond just providing capital, you offer hands-on mentorship and strategic support, working closely with founders to turn great ideas into sustainable businesses. So in this episode, I'd love to get into a few things. Firstly, what makes a hardware startup truly investable and the biggest mistakes founders make when pitching to you, the shifting landscape of UK product design and manufacturing and why the British Design Fund is doubling down on physical product businesses, and lessons from the front lines of scaling product companies, what you've seen work and what doesn't. And of course, we'll go into some of the exciting companies in the BDF portfolio and what's next for the funds. Damon, welcome to the show.
Thanks a lot, Chris. I think you did a very good job there. Flattered.
Thank you very much. No, it's that's always the hardest bit for me because it's the only real bit of the show that's scripted, and I have the privilege of working with some incredible companies and some incredible people, but they don't have to make it challenging in the sort of pronunciations. But no, it's wonderful to have you on the show. So why don't we start right at the beginning then, and what kind of where that will begin, to just give us a potted history prior to setting up British Design Fund.
Yeah, sure. So at this point, I always kind of feel like a little bit of a fraud because I'm not classically trained in design or engineering. My undergrad, but I've always been kind of creative as a kid. I've always, been building stuff, like coding, creative in all technologies as well as sort of slightly more hands-on stuff. So building computers, coding from a young age, writing computer games and stuff, and then always like modelling and building like landscapes and stuff. All the good stuff that kids get into. So I've always been very creative. But I've never. When I went to university, my undergrad was techie, so it was IT. It was kind of database design, systems engineering, really. And then my postgrad was European business. So nothing leaps out and would indicate that I was going to go on and spend my lifetime, in factories across the world and then investing in sort of hardware technology. But how I ended up there, the very sort of brief history. So I kind of in my undergrad, I had a placement year, and that was IBM. It's obviously like a software thing. So placement at IBM, and it became really obvious to me, and also quite obvious to my manager and my personal development manager there for that year. It was fairly obvious that I wasn't really cut out for the corporate life. I just, I wouldn't say I misbehaved, but it just didn't work for me. It just didn't resonate, and I didn't get on and do so great. So I came back. So I finished that placement year, came back and finished my undergrad, and really wasn't sure what I was going to do. My experience kind of working for a corporate, and as amazing as IBM, like on the CV looks great, but it just was enough for me to say, okay, I don't think I'm built going to do very well if I stick to corporate stuff. And then an opportunity came. A mate of mine was working out in Luxembourg for a kind of, I guess you'd call it like we're going back to 2001 or the summer of 2001. A mate of mine was working for a tech startup, like a fintech thing out in Luxembourg. And I went out and I was super technical, so they had me kind of coding stuff, but I loved it. Suddenly I was in this small, they're all kind of finance banking people, but startup, proper little startup, there's like 20 odd people there, and I was getting exposure to the board, to the, not necessarily the investors, but like exposure to the team all the way up, very obviously different to big corporate. And I really enjoyed it. And I did that for about sort of 3-4 months. Came back and then I'd always planned to sort of do this masters back in London, so I did European business back here. But when I finished that, I had then this experience, my two contrasting experiences, one of working for a big corporate where I wouldn't say I really created much value at all. And then the second experience where, I felt like I had a real impact. I'm sure the guys don't remember that placement kid that worked for them for 4 months, but it had like a profound impact on me. I felt like, I was part of the team. Like I did something that made a difference. I really enjoyed it. So at that point, I kind of knew, I need to be in that kind of environment. I need to either set something up or be in a startup, like in a small agile company to be satisfied and to make something of my life. But the problem is, so I finished this master's though, and you obviously then get approached by all the usual, the usual corporates themselves, like the Accentures of the world. They all hang about these MAs and MBAs and try and poach you out. And none of it, all of it I knew was fraught with danger. I thought, if I go into any of this, I'm just not going to achieve much. So I kind of, at that point, I knew I had to come up with some ideas, but I didn't have any ideas for a company. And to fill the time so I could earn some cash and also kind of broaden my skills, I did a little bit of contracting. It was a little bit techie, but I purposely took a sort of contract with a US drugs company where they needed someone like an analyst to look at all of their like loads of Excel stuff, but crunching through numbers, looking at profitability across like drug lines, basically. And that was good. And at the same time, they also paid for me to do something called SEMA, which is like management accounting stuff. So all of that. So that really helped my kind of real world analytical stuff. And I had identified it. I had a hunch that I was missing that. If I was going to go out and start something up myself, I had all the academic training and, I knew what a P&L looked like on a balance sheet, but I hadn't really put it in real world context. So that I only did that for about, I don't even think it was a year, to be honest. But again, it was all part of my plan after my master's. I thought, let's get some experience. And then during that time, just come up with loads of ideas. And obviously the thing is, because if you sort of ignore the bit when I was at university and stuff, my undergrad being sort of software stuff, basically my passion was always building stuff, right? I always been constructing stuff. It wasn't sort of terribly surprising that, when I'd come around to kind of coming up with business ideas, a lot of them would be product based. And I was out of uni as well. You'd have all these funny sort of ideas for things you could make, everything, and everything seemed possible. So I came up with a really funny little consumer product that I thought was a good idea. It was a little bottle opener that counted how many beers you had. I mean, that's how I got into it, strangely enough. But I had no production experience. I really wasn't like a product designer, but I wasn't sort of fazed by the idea of making stuff. But it's also that kind of penny that dropped, and then thinking, I think I could probably sell a few of these. It can't be that hard. Let me. And then my logic at the time was, let me try and find a factory that can make these, and that's what kind of took me to China. And this is before. I think Skype was possibly sort of coming into existence, but I remember using stuff like Yahoo Chat to find these factories, and I was and I think Alibaba was in its real infancy. So I kind of found factories that made similar kind of products, and then was emailing them, and ended up got 18,000 of these things made. I mean, I did manage to sell them all. I'll be honest, I had to discount quite a lot of them, but it's obviously that's what took me out to China. It was that thing there, then wanting to get on the ground and see how it all worked, and that's how it all started, really.
Wow. And that was that Spinning Hat, was it?
Yeah. So Spinning Hat's in. So that business started. I mean, it went through a few little kind of pivots, but it started obviously because it came up with this idea for a product. What I realized very quickly was you can't run a business with like one. You can't, I'd be phoning up retailers telling them about this product. I mean, I'm fine admitting, right, it was a pretty terrible product. I was phoning up these retailers trying to sell it. I did have a catalogue because there was only one product. But I did manage to sell to a bunch of onlines and slowly start figuring it out. But what became obvious is they needed, for this to work in any way, for it to be able to pay my rent, I needed to have at least some more products, and I couldn't afford to keep, making 18,000 of these things at a time. So that then took me out to China and starting to sort of find factories that were making kind of nice stuff that didn't have and maybe representation so much in the UK, and then I'd buy small quantities and start shifting that. So really, and that was probably the first sort of four years or so of the company was more like a trading business, so it'd be me almost, listening to what retailers were saying. Well, we're taking a bit of a punt initially on certain stocks, but then it got to the point where you listen to what they wanted and you go and sort of do a bit of sourcing, repackage it, send it back to them. But what I didn't realise I was starting to learn, but you're starting to pick up on margins. It's some production. I mean, it's all contract manufacturing. It's pretty basic stuff like electronics and things, but, it's all injection molded with a bit of circuitry inside typically. But we kind of got familiar with stuff. I was starting to learn the kind of, I guess, how you communicate to retail buyers, what they need to know, FOB terms, all this sort of stuff, and obviously payment terms and margin requirements, and slowly built that up. And that was my sort of first, that was the first sort of 4 years of it. Then flipped it, right, because it got to the sort of heading towards a financial crisis point, so 2007, 8ish. All of my costs were in dollars. I had no control over my IP effectively. I was just buying from factories. The majority, we weren't really designing that many things. A lot of it was basically just trading stuff. And all my costs were in dollars. Pretty much my revenues are all in pounds because I didn't own the IP, so I couldn't really easily export the stuff. And I could see it all getting squeezed as the that margin got squeezed with the FX movements. And I made a bit of cash in the business. It wasn't like a super lucrative thing, but we made a bit of cash. So sort of this is where we sort of pivoted a bit and started to bring on designers, build up design resource in-house so that they could design stuff that was our own IP that we could then invest in, tool up typically out in China, and then sell it to the world. That was a bit of a pivotal moment, and it was born out of necessity. It was, arguably, if the financial crisis hadn't come along at that point, maybe, I could have got another 2 or 3 years. I'm sure at some point there would have been a crash, but another 2 or 3 years, built up my volumes, margins would have been a bit more protected. But I was always this like guy operating in the middle, small volumes, tight margins. So it really hurt when that dollar sort of shifted.
And what impact did that pivot have on the business then after that?
Yeah, so it allowed me to then, a couple of things. It allowed me to take control of our our NPD, right, our product development. Suddenly it was like within our control. So, I mean, the downside is you've got no one else to blame when the product flops, right? It's basically my fault for signing it off. But yeah, we had control of our IP, which is good. I mean, none of this stuff was patented, it was all kind of retail product things. But we had control. That means we could kind of be much more flexible when pitching to retailers. We could almost start designing for them, listening to what they said, what trends were coming through. We could observe trends coming through sort of 12 months sometimes before the season that we were selling, and we could adapt that into the hard goods. So that was one thing, and that was important. And then that also meant that we could export a lot easier because then we could appoint distributors in different territories. We could open up the US market because people couldn't get these products unless they bought it through us because they're our own designs. So that kind of helped. And then one of the triggers for this was this FX rate, and what this also did is it meant I was suddenly kind of hedging my FX exposure because I was invoicing a lot of people in dollars, and all my factories were being paid in dollars. So suddenly I had no FX exposure on my cost, which was like that's kind of what I was planning to do. But yeah, and then that. So then that was another sort of 5 years of doing that. It was a lot of fun. Didn't make a huge amount of money out of it because it was a very expensive business to run. We were supplying
high volume, low margin stuff, is it?
Yeah, and the clients, we kind of got. I mean, it was all retail, but a lot of fashion retail stuff. So you get into this sort of autumn, winter, spring, summer cycle. You're constantly in a discussion, no matter how great your products are selling. You're always in conversations with sort of head buyers saying, "Great, that was really good. Like autumn, winter performed really well. What are you doing for spring, summer?" I'm thinking this isn't a white T-shirt. I'm tooling this stuff up. This is quite expensive to sort of make. And in that time, you didn't really do direct to consumer so much. It was you're always a little bit cautious. Like the retailers still had a bit, resale, like the wholesale channel still had a bit too much control, to be honest. So they could sort of pressure you, and it was accepted in our industry that you didn't really go direct because you'd be competing with your big customers. Obviously, it's totally different now. It's completely on its head now. We always say to consumer brands, get out there, get that sticky stuff, go direct to consumer, build it up, and then let the wholesale come to you.
Yeah, I noticed that during the pandemic because I was running online roundtables with my clients. Obviously, the world turned upside down, and it's like everyone's got to work remotely. But consumers still, they wanted more stuff than ever, really, in those first year of the pandemic, didn't they? So a lot of the consumer brands I was working with up until that point had maybe been thinking about going direct to consumer, but then it became a priority because all the shops were shut, especially if it wasn't a key product.
Yeah,
They weren't key workers.
and it hasn't reversed. I mean, it's stayed, and you can see retail sort of struggled. It's a tough sector.
Yeah.
But so that's that kind of that second part of my sort of product life, I guess, when I was the manufacturer and the designer. We ended up with sort of a few offices around the world. Launched a lot of product. I don't know, probably our own brand, 400 or so maybe SKUs. And then we did a lot of private label stuff. But what it fundamentally taught me, I could walk around a factory, I could price things up, I knew how to get stuff made, fairly simple things, that you can get your head around. It's simple kind of engineering. But I could also then sell those very well and open up markets. So that's the kind of skills that I had at the point. And then we got acquired, the brand got acquired by someone in our market, not like a huge exit, but it gave us the opportunity to kind of move out of that space. And I felt like I was getting to the point I'd learned not everything there was to learn, but I like setting things up. I don't necessarily like sort of managing them indefinitely. So I'd had the huge learning curve, and there's the opportunity to sell the brand. And as these things happen, right, it kind of always ties. Starting a family, my wife was pregnant, loads of changes, sort of settling down in London, and it kind of felt like the right time to maybe start have those chapters, that first book kind of done. Me basically being in China for a lot of the time and manufacturing sort of high volume, like you said, low margin stuff, but also stuff that didn't really change the world. Now this did sit a little bit on my conscience, I'll admit, but it really sat kind of when you have that year or two of figuring out what your next move is going to be, your next venture, you think back to what you've done. I was really proud of what I've managed to achieve, basically bootstrapped it really. But I was very aware that, the last kind of almost 10 years of my life, I've been making stuff, really nicely designed stuff, very proud of it. The design teams were great, really nice designs, but none of it made the world a better place, really. It did, in all fairness, end up on landfill sites at some point. It wasn't essential to the world. And I kind of felt what I'm going to do in my next venture, I wanted to make sure it had a bit more impact. So that sort of brings us up to the start of the British Design Fund. And I won't go into as much detail really on kind of how that started, but a basic group of like-minded individuals sitting around the table saying, all of us having made money in manufacturing, being in the UK and looking at it and saying, why is it so difficult to get funding to early stage hardware engineering companies? It's just nuts. Like great ideas, good IP coming through. Why won't investors talk to them? Like, why is there such a lack of investors that will talk to them? And that kind of came, it took a year or two after sort of exiting the previous brand, but it kind of, I guess the penny dropped quite soon. But then I wasn't a VC guy, I was a manufacturer, so I couldn't jump straight into it and take the opportunity. I took a bit of time to sort of figure things out and structure them.
Yeah. So what were the days before British Design Fund then, what were some of the biggest lessons you learned from being on that side, on the founder side, that I'm guessing influence kind of some of the conversations, some of the questions you ask as well, I suppose?
Yeah, so probably the most important lesson from that, and it's, the most important lessons are the most painful to learn, right? But it's probably that cash flow. You'll be amazed, because everyone thinks hardware's hard and it's a nightmare to scale and all the rest of it. But there are all kind of tweaks you can do to your cash flow model that just make it work. You could almost have two completely separate conversations. You could have an accountant sat in the room looking at your 12-month forecast, right, and they just model it out, and they say, there's no way you're going to need to borrow, like £3-4 million to fund this lot. And then I'd come in and I'd sit down and say, well, wait a minute, right? We're going to sell a load of this stuff FOB, right? My factories are going to give it to me on like copy bill of lading. We can finance on the back of that. That gives me 30 days on sea. But it was quite high stress. But you'd have, at any one time, you might have kind of, 50 plus 40-foot containers moving around the world, moving around the oceans. And they'd all be at various different like levels of finance and games being played and invoice financing one that's been FOB'd. So I think that was the thing, that the ability to juggle that cash flow, you'll be amazed what you can pull out the hat with a bit of kind of creative and everything completely above board. but there are so many things you can do with the stock business to kind of to make some of those that make that cash flow work. So that was probably the most important, because everything was kind of cash hungry. It was constant orders going out of the door in China, out of our factories in China. It was then constant retooling. So you always have this NPD stuff. So all of the tooling and design costs sucking up almost all of that. Any cash you generated kind of got sucked up into the next year's development. And then you'd obviously have the retailers, and we were supplying like most of the world's sort of biggest retailers, right? Their payment terms like are terrible. They stink. So then you got all of these pressures, But even through that, as a really small startup, you managed to get through it by just learning the tricks of how you can juggle cash flow, stock, financing options and stuff like that. So that was super useful, because sometimes we'll sit with a startup now and they always, unsurprisingly, well, sorry, not unsurprisingly, they just won't know this stuff. They'll just see this brick wall. Have you thought about you could do that there, and maybe don't just go direct to consumer? Maybe it's not too bad to get a little bit of wholesale, sell it FOB, finance that bit. All these little things come into play.
Yeah, I met a guy. Well, I've got quite a few actually out at CES when I was there early in the year, and you think of CES for a lot of innovation, and I certainly know a lot of product development professionals, but this guy sold well over $1 million worth of stock. I said, "Oh, what was your business?" And he says, it's mini projectors." He showed us a render on the screen. "Oh, that looks smart." I said, "Yeah, sell them for $400. Cost me about $60. I just buy them from China and then package them up and resell them. And it's like $60 in, 340 out. We're making good money." And then later on that day, when his business partner was there, he said, "Oh, sorry, we just got to take a call." It was, I think, Red Bull were doing an event, and they wanted hundreds of them to give away as gifts. And he'd just taken an order. It's like, "Can we do that?" And he just shouted over to his mate at the bar, "Yeah, we can do it."
There's a real beauty to product businesses.
Yeah.
I mean, look, a lot of the stuff we do at the fund, to be fair, isn't sort of consumer as such anymore. But I used to really enjoy that idea that you once you've done the design work, you are shifting boxes. How you finance those boxes, but you're shifting pallets of boxes around the world. Each of them's got each unit in each of those inner cartons and outer cartons, all carrying a bit of margin. That's how I used to look at it.
That's brilliant. So there was a couple of years between kind of exiting Spinning Hat and obviously starting British Design Fund. At what point did you start thinking about early stage investment as the next step in your career?
Yeah, so it was during that 2-year period. It might even have been a bit longer than 2 years. I'm trying to remember. Let's say it was 2 years. I was giving a bit of time at the Design Council, who'd helped me out over the years with my product companies. And it was there, I was on this program called Spark, and it was there that I was getting exposed really for the first time to loads of product startups. I mean, it sounds weird. I mean, I was basically a product startup myself, but you just head down. Do you mean like head down building a business? I wasn't really hanging out with other product startups. So when I was back in London, I'd sort of I'd hang out with other entrepreneurs and stuff, but not many of them were in product or design as such, really. So this was the first time, and I was there to kind of give them a bit of to sort of share my experience of building product companies and give them an idea of how they can commercialise their own ideas, which went down very well. But what we noticed, so myself and Design Council and the team running this program, was these companies were kind of coming back, taking our advice, going away, continuing the design work, but obviously they need more funding to take the things through to market. And they'd all come back and say, "Look, it's been really helpful listening to you, but we cannot get funding." Like, every investor we talk to, as soon as they figure out there's some hardware, that we're kind of like an engineering startup or a product startup, they just don't even reply. They just cut. They cut them down straight at that point. And it wasn't just like one or two. Basically, every sort of inventor that got onto these cohorts was saying the same thing. So that's kind of where the penny dropped. And at the time, the chap that was running the Design Council, the CEO, was a chap called John Mathers. So I sat down with John, and I sat down with effectively the financiers of this program. It's kind of being philanthropically funded. So we had us three sat down saying, "I think there's a problem here." And now the kind of philanthropic funder had a problem because the only way they wanted to leave a bit of a legacy supporting British product design, and the only way this would work is if these products actually made it through to market, and that meant they had to get more funding. So they were a bit grumpy. And then at the Design Council, so John was saying that this is a challenge. We're running these programs, amazing startups, but we're judged on how many get through to market. And there was like a sort of, it repaid for itself over the years, but it did need these companies to hit revenues. And then I was sat there going, well, I'm kind of looking for my next venture. It all kind of slotted into place. But it wasn't like then in 3 months' time we started the fund as such. But that was where the penny dropped. And then I just spent a bit of time, a couple of years, kind of investigating, getting to know the landscape in the UK. What were funders putting money into? What was the VCs putting money into? And I just couldn't find anybody that was a smart hardware investor, like early stage smart hardware. It still doesn't, apart from VDF, there really isn't in the UK many at all, to be honest, that exclusively do it. But that's kind of where the penny dropped. But obviously, we describe ourselves as operators. We're obviously investors. We say we're operators because we've more been founders making, designing things and manufacturing them than we have investors. Maybe it's getting close to 50-50 now, actually. But yeah, so we then needed to kind of learn how you structure a fund and get all the advice. It's a regulated industry. There's a whole load of stuff to figure out. But fundamentally, that kind of what we say, that investment thesis, that gut instinct of there's a funding gap here. That was a bit of a penny drop moment. And then you obviously finessed it, right? You have a bit of an investment thesis. You go out, and we went out sort of pre-COVID with a small kind of group of investors, and we learned a lot there. Came back really sort of 2021. So when we came back and we'd really nailed the thesis, we understood what made us unique, but we also understood what. Because it's not good enough to just find a gap in the market. You've got to find that market in the gap. So we knew there was this big gap, but where could we operate, which actually played to our advantage as an investor, where we could price things correctly, not fall into the trap of competing with lots of investors at overpriced valuations. We could have an impact on these companies, genuinely help them get them through to market, understand the TRL, like to go in at, it's like TRL5, all these sort of things clicked into place post-COVID. That, pre-COVID, we were kind of figuring it out as a proof of concept, but I'd say from 2021, and it hasn't really changed a huge amount. The portfolio, possibly the sort of flavour of the portfolio is, ever so slightly changed, I guess, sort of since 2021, probably is more, I'd say it's typically more engineering led now, but fundamentally that thesis, that those key criteria, that the investment mandate that we have and the promise we make to our investors pretty much remained the same since 2021.
So, yeah, it's interesting. It's you've been on quite a journey from the manufacturing point of view, starting a business in product and then having to learn a whole new industry, although you kind of go in pre-armed with lots of questions and experience. I imagine a completely different game, isn't it, in terms of having to, I guess you're kind of accredited by the financial side of things and making sure that kind of money's been put in the right place. But how do you go about even starting a fund? I get with a product, go to China, pick a product and then put it in a box and sell it. But how do you start? Yeah,
I'd say none of this stuff is rocket science, right? Everybody, there's very few things in the world that are hard to kind of figure out. But with this, so obviously the big difference, well, a couple of big differences from my previous businesses. So this is a service business. First time I'd had a service business. So, I don't have, my balance sheet isn't full of stock and tooling and stuff like that. My balance sheet is pretty simple to understand, right? It's a service. It's largely a P&L business. So that was one sort of shift. Now, I'd say that was kind of, it makes life a little bit easier from a financing point of view. It's quite easy to dial the costs down. And then the other one is obviously regulated, right? So you can't get around it. You have to school up and get your head around the regulation. Now we partnered with a fantastic firm, Sapphire Capital, who I'll share this with them. Actually, Boyd will find it very funny. But Boyd and Vasiliki, the sort of founding partners of Sapphire, I'm not entirely sure, and maybe Boyd can answer this after he sees this video. I don't think he knew how little I knew about the regulated sector when I first approached them. So I got introduced to Sapphire. This is right at the early stages. We hadn't really even got an investment thesis together. We had a bit of an inkling. I remember Sapphire taking us on, and Boyd in particular spent a huge amount of time. Really, he had to kind of teach us everything, to be honest. Now we've been doing it. We've been doing it now, I guess, sort of 6-7 years, but really intensely, probably sort of 4 years. But now we're very good. But it was a really steep learning curve. Even the basic stuff, shareholder agreements, subscription agreements, ASAs, like IP assignments. And then you've got all of the FCA stuff beyond that. What's considered a promotional activity. So much regulatory stuff. So we can only do that because we partner with a firm like Sapphire, that ultimately they have the say over everything that we do. We will be, we find these fantastic companies, we attract investors, but there is an absolute line where we say, look, this is a regulated activity. Sapphire, this is over to you. So they've been fantastic. I mean, yeah, it wouldn't have been possible to do this. I don't think you could. I could not have, no matter how much cash I'd thrown at it. I think it would have gone very well if I'd suddenly gone to be fully regulated myself, set up a fully regulated business from day one, having no experience. I mean, you'd obviously have to bring people in, but you'd be bringing people in and you wouldn't know how to manage them because they'd be talking a different language. Whereas now it's kind of, I can comfortably talk to these people, I'm doing it long enough. But yeah, it's a rapid learning curve. But yeah, just like a product startup, they're passionate, like I think typical founder profile for us, they're passionate. They've got the technical skills. They've probably got some insights in the market. They basically want to make the world a better place. They've seen a problem they really want to fix through a hardware engineering solution. But the rest of it, they just don't. They don't know how to. They probably haven't tooled something up on their own. They haven't taken a product through to market. They haven't opened up international markets or licensed IP. Or there's so much to learn. But you just, if you're, I'd say one of the most important things when you're starting up a company is that like where you plant that flag. What is your what's your kind of North Star? What do you truly believe in? What's this gap you found? Everything else is kind of detail. It can be a huge amount of work figuring out the detail, but it's as long as you really believe in it and you're doing something important that the world kind of needs and is willing to, I guess, pay for in some way, then you're not halfway there, but at least then all of the hard work that comes behind that, like figuring out how you get to the top of that hill, which won't be a straight line for sure. At least kind of each step of the way, you're reinvigorated and sort of re-galvanized by the fact that everybody around you believes in where you're heading, and not everyone has the answers. No one can give you all the answers. You just have to crack on and figure it out.
Absolutely, or have some advice and help from people who've been there, done it, or know people that have been there and done it. So on that, what kind of things does the fund look for, or you in particular, in a really strong investable hardware startup?
Yes. So, I mean, the headline stuff is you've got to be able to kind of kick it or drop it on your foot, right? So there's got to be some hardware there somewhere. But basically, we're looking for the stuff, and this is specifically for BDF. We look for technologies developed within the UK that are addressing a really important problem in the world, right? They really, or a compelling need. Like they really are going to make the world a better place. They're really needed. If this team doesn't launch this technology, someone else is going to come along because it's so important that this gets through to market. So we look for those kind of technologies. Now, all of those technologies will require some element of manufacturing. That's, we have to have that. So that's kind of headline stuff. Then I'd say sort of, so that kind of gets you through the door, let's say, if I'm thinking of our selection process, that would get you sort of step one. Then we start to look for things like, like level of development. So TRL 5 ideally, so working prototype, demonstrable prototype that you can show to a potential customer, because we need to see some indication from market that there's some demand for this. So if those conversations haven't happened, then we'd say, right, okay, look, we love what you're working on, but come back in 6 months maybe. It'd be a little bit too early for us. We also need to be confident that technology will attract some IP in the form of patents when the design work is finished. And we know it's an ongoing kind of process, right? You're not going to file it once, but the problem they're addressing and the technology they're using should be generating patents, not at the point that we invest, but we should be comfortable that there's freedom to operate in the next sort of probably 12, 18 months, patents will start being laid down. And then revenues, we don't like to be too, so that combination of kind of TRL 5 and then, TRL 5 and patents on the way through, along with kind of revenues not being too far over the horizon. So we aim for about 12 months, ideally. In reality, it ends up being 12 to 18. But when people are coming through the process, we'll be asking, right, is it feasible with us and maybe some other money and some Innovate UK and our mentoring and coaching? Is it feasible to think that we could get this business to the point of revenue? Now, if you're a heavy regulated product, right, we can take stuff like research revenues is fine. That's how we approach medical stuff. But what we won't do, we're not going to kind of do like some complex therapeutics sort of deep science thing that, no way going to see real revenues for sort of 5-6 years. That's not the field we play in at all. We like it to be more mechanical, understand the manufacturing processes, maybe not understand all the sciences that are going on inside, but understand the manufacturing process, get it and be able to be confident we can get it through to market, into markets where we can help them. And again, with medical device stuff, that does include stuff like the NHS, but we'd also look at other kind of other.
I'm interrupting this episode to share some exciting things happening around why design. At the core of this podcast are the incredible design journeys my guests have been on and where they're heading. And these journeys stem from the relationships they build, the communities they're part of, and the amazing achievements that come from collaboration. So beyond the podcast, we're hosting regular online huddles and quarterly meetups in the UK, with plans underway for an annual gathering in the US. We're also running hands-on workshops both in person at Makerspaces and online to connect and inspire people in physical product development. So if you'd like to join us or stay in the loop about upcoming events, sign up at teamkodu.com/events or click the link in the show notes. Now, back to the episode.
But yeah, I mean, that's and I guess sort of some of the sort of things that will maybe stop things going through our selection process, because people might be sat there listening to this and I'm sure that's ticked mine. We've got to have there's got to be an attractive enough market. The scale of the problem that you're addressing has to be big enough. You've got to think we're an investor, right? It's got to be big enough that we can make a return. And you've got to look at that size of market and penetrability of that market, like how can you access it? At the same time, think about what your valuation is today. So, if you've got a kind of small market and you're overpriced, then invest. And it's not just us. People are looking for a return. So the returns are normally, a point of exit will be that you've penetrated that market, is an attractive market that you're scaling and you'll hit your scale up and growth stage, and you've come from a sort of sensible, grounded valuation. Then founders and investors will be making money. What you want to avoid is kind of that trap of slightly flattering valuations at the start, that you can always find someone that will go along with that price, and then you end up in a down round situation, and things are getting a bit expensive and overpriced, and your market's proving harder to open up. And it's a really difficult conversation if you're looking for foreign funding. So we sort of avoid those things. And I suppose really the other thing I'd say is really ask yourself about the kind of the positive impact that your technology will have in the world. So, and this is just for us as BDF, right? This is just one of our criteria. But I'd really say, think about sort of, if I don't launch this, is it so impactful that someone else will, or is it a bit of a nice to have? If it's on the nice to have thing, it probably won't go too far with us.
Yeah, absolutely. Are there any going back to like the size of the opportunity? Because, like you say, you're a team of investors, so you need to see a return. Ideally, kind of around the 12 to 18 month mark, or at least it's starting to start making money, so it's showing a return then.
Yeah.
But are there any resources for founders going into that conversation? How do you find out what like the total addressable market or the total serviceable market is?
Yeah. Okay. Everyone, well, not if you haven't seen a pitch deck before, maybe you don't know stuff. But most founders will present something that's got like a huge TAM, slightly smaller TOM and SOM and all the rest of it. So it's kind of your total addressable market. You can find this stuff just by Google. It's all available online. Investors, we expect to see probably like a very large number. The total addressable market we expect to be huge. But then as you boil it down to then the actual serviceable, obtainable market, that side of things is where I'd say you want to start. You can work, because what we typically will see is, I don't know, like a medical device going to a certain sector, and they'll know how many of this certain thing is. Or within this, like the entire market for, kind of, I don't know, healthy aging, Alzheimer's support or something is this big. And then within that, you have these territories we're looking to target, and then within that, our obtainable market, so like the first sort of initial push out, that will be then very focused down on kind of what is your route to market. And that should be backed up by a fairly easy to understand and executable sales plan. Nothing too complicated. Again, don't just pluck numbers in the air. Start to think when you get to your SOM. Start to think from the bottom up. Because you'll be making some top-down assumptions to get to your SOM, but then when you get to that SOM level, you should start thinking about, right, literally how many of these would we have to sell? How many and how do we get it through? Is it through distributors? Let's pick up the phone to them and see how many they typically sell. Like we're selling Lancets. How many Lancets do you typically sell within Europe per year? And start to do a bit of the two-way thing so that when we get down to that point, because that will be the market we're looking at, and say, right, well, how realistic is that? And then you start to, and once you got to that point, I think, and all of that stuff you can get, get to the British Library, or, you can find it online. This isn't, it doesn't need, there's so much risk in these companies. This isn't like you're producing a dissertation and you have to, every single reference was scrutinized and, and taken as kind of writ. We take everything with a pinch of salt, basically, and we apply risk into everything, because it's all just so risky. But equally on the flip side, you shouldn't come into it saying, well, it's also risky. You know, Damon says it's all like a bit of a pinch of salt and all the rest of it.
Just
so we're just going to kind of wing it and make it up. You know, that equally doesn't work. You know, but it's definitely that huge, like the total addressable market is always like slightly academic. But I'd say when you get to that SOMS, that should then start resonating with your financials, you know, your commercials. Like, what is your sales and marketing plan? Like, who are you? Like, how are you actually getting this amazing contraption? How are you getting that into the hands of your users? Because they may very often are not the customers. Let's go one step up from them. All right, there's some sort of wholesale activity of some sort. There's some institutional buyers. Well, let's pick up the phone to them and see how many of these sorts of products are they likely to sell? And again, at some point, you're going to want to get a letter of intent or something like that to come to us. So again, at that point, you can start to flesh out some of that. You can sort of sense check some of the stuff in your numbers. And again, the other thing to do is if you're looking to kind of penetrate, I don't know, anywhere near 50% in your serviceable market, like you're probably being a bit too aggressive. You know, it's sort of, you can have all these sanity checks. Like, are you really going to penetrate it so like successfully and rapidly that you become a dominant player in the first few years? That's really, really unlikely. You know, so again, all this sort of stuff we look at to just sense check stuff. But to be honest, we put a good layer of risk into all the numbers that we look at. Without overthinking it, you just go mark it down. You've got to mark it down because because I guess the advantage we have as investors, we see this. You know, we see so many decks and we track the performance, and we obviously closely track very closely the ones we invest in. So you can kind of see, you know, you know what your pitch, you know, the number you're pitched is not the number they're going to hit. You know, we know that because we see them every, you know, it's great. We want to see enthusiasm, we want to see optimism, but we as investors go, okay, well, we know it's not going to be that number, and it's probably not going to be sort of, in the first couple of years, it could be wildly different. So does it still work if we put this much risk in for the first couple of years? What cash issues does that present? But yeah, that's kind of where it becomes sort of down to us and our analysts sort of looking at stuff.
When you turn people away for, obviously, for whatever reason, you know, whether it be they've taken too much salt in their pinch, you know.
Yeah.
Did you find many come back with improved pitch decks, and if so, how many of those typically will then go on to secure funding?
Yeah, so I don't have the stats to hand, but we encourage them to come back. So if you get to one of our pitch days, you are already, you know, so we invest typically about one company per month. So 12 per year comes from about, I think it's from about 650 or so interactions, not always applications, but interactions with like inquiries coming in. So to get through to our pitch day, which is every 6 days, every 6 weeks, we see 6 companies. You're doing very well. You're already pretty impressive, to be honest, to get that far. So we don't want to, you know, it's in our interests, you know, to make use of all the cost of getting these, you know, to finding these companies and getting them through to that point. It's in our interest to maintain a relationship with them. So no, we encourage them. You know, it's very rare that we'd not encourage someone to come back. But there's somewhere we'll say, look, having now really understood your market, it's one that we can't really add value to. That's a bit of a, you know, if we get to that decision at a pitch day, then it's, you know, we'll certainly try and help them out, find some other investors, but possibly, you know, we're unlikely to change our ability to support them over the next year. But quite a lot of the times it'll be that they're just a bit too early, you know, and we'll say, look, you know, we love what you're doing. You're just a little bit early for us, right? Come back in 6 months, you know, stay in touch with us, and then get back in. And yeah, and there's a certain that you sort of fast track through the system a bit, you know, you then come back in and pitch. So we'll send a note out and say, right, to my selection committee and my selection panel will say, right, okay, we've seen these guys before 6 months ago. We think now that they're ready, actually, you know, they've made significant improvements. You know, IP's almost filed. They've got these 3 letters of intent from, you know, partners and all the rest of it. And we'll say that we think this is an interesting one to see. But I don't know, but and each pitch day sort of changes. So out of the 6, I'm trying to think, we had one last week. I think they were all of those 6 were new, I think. But it's not unusual for us to have maybe 1 out of the 6 that's one that we've seen before. And we have invested in quite a few that have come back. Again, I don't know the number off the top of my head, but I can think of definitely 3 out of the 40 that were ones we encouraged to stay in touch and then invested in when the time was right.
Oh, interesting. Yeah, it's just a lesson in kind of take the feedback and then keep going. But I'm guessing there's as much value in a rejection in some cases. I was speaking to Claire from Untap recently on this, and it's a slog going through the investors, but the questions that get asked really kind of give you stuff to think about and really help you improve as a founder.
Yeah, and also this, and also the feedback you get from Innovate UK and stuff, places like that. Because investors are, I mean, there's no one, and the thing is, they've got to remember, right, investors are fallible. They're humans, right? And they make mistakes, and so there's always a danger you could listen to everybody's, and your head spins around, and you end up just staggering around, not knowing what to listen to. But I think you can kind of take a grounded approach and go, right, okay, you can't please everybody. You cannot meet as a startup. You can't be the right investment for every investor. It's just we've all got weird investment theses. I've got weird stuff in my thesis. It works really well for us, but that purpose-led bit throws a lot of people off the but we know what it means and it works really well and we're performing well on it. But then another fund will have something slightly different. So kind of understand what those really important metrics are, what those important investment criteria are for the different funds, but they'll all be different and you can't suit all of them. They'll have different revenue requirements and all the rest of it, right? But also stuff like Innovate UK is good. I mean, the feedback you get from them, I was talking to someone last week about this, can't recall who it was, but someone was saying part of the due diligence they do is they ask even if the company's had a negative response from Innovate UK, so they failed to get a grant, they said actually put that in the data room because it's so valuable. What you can do is put a document in the data room with the negative feedback you've had, and then how you'd counter that. So, don't just dismiss it and say, they just didn't understand my technology. Actually go, well, what is it they didn't understand? And try and repitch it in and have a little document that shows your kind of how you'd kind of counter it and the lessons learned from it and put it in the data room. Because it's actually quite useful. It's quite a useful exercise to go through.
Yeah, that's brilliant. So, in your experience, then, obviously, we like. I think I asked you this at a hard stuff event as well. We want companies to succeed. You're investing in things that you believe in. You think are going to succeed, but clearly not all of them do. What separates the startups that thrive from those that struggle after securing funding?
A lot of it, yes, just a few factors. I mean, like personality is like the personal makeup of the founding team, and we're not just talking about chemistry. Chemistry is important, like how they work together, but the actual, that sort of the personal makeup of them, like their ability to withstand all of the difficult stuff that's going to be thrown at them is a big one. And we never know. We try and, you can't see it. You do your best during before investment, but really you only start to figure out these things post-investment. So I say kind of things like sort of founder burnout, ability of a founder to persevere on, ability of a founder to kind of, pivot when stuff gets hard, but also not pivot to every single requirement, stay a bit focused. All these kind of things are pretty important. And I say we're pretty good at picking them. Like, the vast majority of our founders they're well grounded. They are largely engineers, and what we sort of look for, if they don't have that commercial skill set within them, they'll have a co-founder that's commercial. So we do pretty well. Like we usually end up with quite robust founding teams, but when one slips through, and you kind of know it quite quick, usually within a few months, you sort of go, okay, this is gonna. Won't necessarily mean it's a fail. It doesn't. We've got a very, very low failure rate, right? Most of ours don't fail. But you just know that you kind of know that they're going to be a bit more work. You're really going to have to throw some stuff at this, and you might need to swap a few bodies around and get some more. It's usually like on the commercial side, so that's one. I think, and then again, unfortunately, we don't have too much of this, but we have seen it before. Like basically burying your head in the sand. Burying your head in the sand is like the kiss of death. Because we're here to help, right? Your investors are in the same. They're in the same boat as you, right? But they just own a really tiny bit of the boat at the back, right? You're sailing the thing, right? But we're all in the same boat. We all want you to succeed, and we will help. We will do everything we can to get you there. But if you come to us and say, look, I've got 3 weeks worth of runway, like I've got 3 weeks until we go bust, that's pretty hard for us to figure out, right?
Yeah.
So, what we want to be seeing is 3 and 6 month stuff. And actually that's something that we've learned over the last few years is often some of the support we give is very rapidly will upscale the kind of governance in companies. It's never what they think we're going to do. They think we're just going to talk to them about injection molding and roto molding and rapid prototyping and all this stuff and commercialization. But sometimes we say to them, right, okay, who's your chairperson? Who's chairing the boards? How can we diarize them for the year every 2 or 3 months? Do you do a CEO report? Do you have a management pack you send out? And often they don't. And you say, let's just look. We don't. It's not complicated, but we need to get this stuff sorted because without it. If you don't do that, you are effectively burying your head in the sand. If you've not got visibility on your numbers, it's like that's where the surprises come. And with a startup, it's different. Like if you're a global, massive company, you can bump along a bit, right? You've got enough cash in the bank. But startups, Really can't. They've got to know. They kind of got to have. We've got to have comfort on what they're spending and what the cash forecast is, and it always changes. I think that's kind of something that founders don't always understand. In their heads, I'm sure some of them think, well, we're always running out of cash. We've always got to be fundraising. Almost like, what's the point of doing a cash flow? It's going to look terrible. We know it's going to look like challenging. Like all cash flows for startups are pretty hair-raising things to go through, right? But we're used to it. Like we can, again, like you asked earlier, some of the useful stuff I brought with me, and us as a team, like we know some of these little tricks. We know how you can stretch your operating cash for a bit, and we can get some more cash in if we've given enough notice. But yeah, it's challenging. If again, we're very fortunate. Our founders are typically they're engineers, most of them, right? At least a good percentage of the founding team will be engineers, and they're pretty grounded. They won't be. They're often not sort of finance experts or expert governance, but they kind of get them. If you lay it out to them as in a black and white way, and they understand why they're doing something, they do get it pretty quickly.
There's a process they can follow. Quite often, it's they're engineers, not business leaders. So, but they need to become both, really, don't they? So. Wonderful. So in terms of the market then, obviously we said we've covered that off as well. We'll fix this. What do you see has changed really in the last 5 to 10 years from the sense of kind of hardware startups and UK manufacturing? And do you think there's more opportunities or more challenges for UK product startups today versus 5-10 years ago?
So 5-10 years. So I'd say definitely a shift to kind of reshoring, like from the actual point of production, stuff's getting closer to home for sure. And I think there's this whole acceptance that, margin just has to adapt over time. You can't have the margins that you're going to have in year 5, in year 1, and I think 5-10 years ago, everyone just rushed to just outsource stuff as far away as they could because they were just chasing a dollar kind of cost of goods. I'd say that sort of change. I've seen that a lot. And there's obviously a lot of geopolitical stuff going on, so not everybody wants some of their tech and IP necessarily dotted around the world. That's one. I'd say that's a big one. I think kind of we've got to see what's going to go on with Innovate and the funding. Hopefully the government doesn't kind of mess around with that, because if that stays as it is, and I think UK remains, I passionately believe this, right, remains the most attractive place to launch a hardware startup in Europe, because there's a few things at play, right? You've got phenomenal talent coming out of universities, coming out of the JCBs of the world, the Dysons, all this sort of stuff. Like we educate engineering and science-based grads well. They then tumble out into great roles. So you have this hotbed of stuff going on in the UK. And then on top of that, when they get to sort of startup mode, there's Innovate UK, non-dilutive, phenomenal, amazing. All of our companies get Innovate money without a doubt, quite considerable tickets. So you have Innovate, you've got things like EIS as well, and SEIS obviously. You've got these tax breaks that make it attractive for investors to take a risk. It make plays into companies that maybe they consider too risky, because you get then a tax break on it all. And then for the companies, back to the companies again, then they get stuff like you got your R&D tax credits and all that sort of stuff. I mean, there's quite a few things in the UK that a lot of other countries don't. And so it's like talent plus the way that the government has interfered with the playing field and made it not level with the rest of, I'd say, Europe for sure, is, it's something that we can do very well. And I know, obviously, you get to a certain scale, you have to have multiple points of manufacturing. It's unlikely you'd only scale a product business with production in the UK, but it can be done. But it's not surprising when we see people open up US points of production and maybe European and Far East and sort of Far East production. But I think I think sometimes people immediately jump to that point in a manufacturing business's journey and say, well, we're never going to be like the world's #1 manufacturing nation. I think what we can be, though, is we can still play really well at that IP generation bit, that innovation stage. And if you think about it, if you talk about UK PLC and kind of tax revenues, I mean, fair enough, these companies will attract tickets from the US and less of it, but that IP, if they're licensing it out, like there's a good chunk of that company's life that will be contributing significantly to the UK economy, making us a really attractive place to play for that innovation stage of the business, without a doubt. The rest of it is maybe hard. There needs more government interference if they want to really play seriously in that space as the companies really, really scale. I think that innovation piece, it's already there. It's ours to lose, which hopefully we don't. A lot of that comes down to sort of government support of Innovate, or tax credit stuff. Which hopefully, I think it's here to stay.
Yeah, I think so too, and it's an exciting time to be involved in British hardware. What sectors or product categories are you seeing most innovation and growth in? right now?
I'd imagine, well, we don't really do defence, right? We do some dual purpose stuff, but I think I will not be surprised over the next couple of, 2-3 years, you see a lot of defence funds. And that doesn't mean there'll be hardware, but just, defence is clearly going to get a big chunk of the government cash, right, over the next few years. And we don't do defence. We don't do things that effectively go bang. We can do dual purpose stuff, so things that can monitor health in certain scenarios. We do that might have military applications. But I'd say sort of there's a lot. I mean, it's continuing, right? So obviously you could be mistaken to think it was a bit of a sort of bubble, and we've moved past like the whole kind of climate, water tech, and those sort of things. But I think there has been, I'd say, there's possibly been a bit of a bubble in terms of the amount of cash that was available for those kind of businesses. The amount of funds that set up that were basically they were impact funds, only invest in startups that have a positive impact in the environment, strip out carbon, all the rest of it. Now, there was so much money that went in, and it didn't really know where to find a home. So you end up with these inflated valuations of companies that have just disappeared. They've disappeared off the landscape, and the investors are scratching their heads and have lost their shirts on it. So that time has gone. I don't think you're just not seeing that sort of level of investment in that space. What I'm seeing, and this is relevant to hardware, is I think there's been a bit of a realization that actually, okay, what we thought of as like a impact climate startup, maybe 5-10 years ago looked very different and was attracting much different sized tickets at different valuations. Maybe it was a little bit harder to even get your head around. It was quite, how is it really, are they greenwashing or not? I mean, and how real is this tech? So now actually, I think there's an acceptance. Actually, a lot of the problems in the world can be solved quite simply through engineering and hardware. Like if you want to remove things from the ocean, like you're not going to do that purely with a bit of software. Some element of hardware probably has to interact. And I can understand the hardware and I can see how that takes this problem out of the ocean, monitors the health of riverways. Usually there's a hardware interactions. So we're seeing a lot of that stuff, like sensible engineering solutions for climate challenges, right? That's and stuff you can just understand at sensible valuations. We're seeing that, and something that maybe that's kind of coming to the end a little bit. I feel like we're sort of at the end of a sort of, maybe we've reached peak kind of agri-tech. We had so much stuff around food security, ag tech for food security. Basically, how could you remove the risk of labour from so many like agricultural settings? We saw so much of it, like the number of slightly autonomous fruit picking, transportation. I mean, there were so many of them.
I remember working with
one,
and
they were running quite high. There's a lot of people putting money into ag tech, but again, I'd say it's kind of like there's been a rationalisation. So now some of the ag tech stuff we see it's really sensible. It's like, oh yeah, okay, you've defined your own market. You're not following the herd. Excuse the pun, but you're kind of you're doing something important, it's unique, that someone else hasn't done in a way that's different. Because sometimes you see these bubbles and you can see 3 or 4 pitch decks. Yeah. You go, surely they're all doing the same thing. Like, is it really that different? And you can convince yourself, because then when you talk to your other, your peers and other funds that are piling money into it, and the share price is going, you think, well, I'm missing a trick here. But no, we sort of stick true to it. Like, we can't, keep it simple. Other sort of trends, probably, and obviously, I mean, look, obviously AI, but AI being deployed in a sensible way. Like, all of our businesses utilize AI. Unsurprisingly, I can't think of any that don't really. Yeah, it's just, but it's putting it in its box, right? It's like it lives in the AI box, and it does this specific thing, which is very useful. It doesn't need to be across every part of my business, but it's we leverage the power of AI to support this hardware and make it operate more efficiently in this space, and we understand that. Okay, great, that makes sense.
Wonderful. Yeah, some really interesting insights there. I did see, from my side of the fence, with my recruiting hat on, I did see I had a lot of conversations with ag tech, kind of robotics and strawberry pickers in the run up to Brexit and that action in, because it's like, who's going to pick all the fruit?
We understand why, right?
Yeah, absolutely. I'm not sure the answer is robots, but
it's fascinating seeing the number of different ways you can solve the challenge of how to pick soft fruit without a human and then transport it.
It's interesting to watch.
Yeah, they are fascinating, because they go really vertical, right? They're like, I'm the raspberry guy. So the strawberries would be a completely different challenge.
Yeah, it's like you've got this articulated arm that comes out, and it's got the most sensitive of touch, and then the sensor, and then these little scissors that come out to release the strawberry.
It's fascinating, but
I'm not sure how you can't really do it quickly, or certainly the ones that I've seen. So I'm not sure how productive it is, but it certainly looks interesting. You wouldn't, if you imagine just bumping into one, you go out with your family strawberry picking at the weekend, and then just down the lane is this robot.
They're out motoring ahead of you, getting all the good ones.
Johnny Five's been repurposed. Wonderful. Look, we've kind of gone over time, but really, but it's been an absolute pleasure speaking to you. I just wondered what, if you're happy to share, kind of what's next, what you're excited about for the next kind of couple of years with BDF, or in kind of your own career, really.
So it's more of the same, but slightly larger tickets, and gradually increasing the frequency of our deployments. Like I said, we're doing about 12. We're doing on average about one a month, and I think by the end of sort of 25, we'll be ticking just above that. 1.5 heading towards 2. I'd like to think, but it's very organic. That bit of our business is all important. Attracting investors is important. Attracting great founders is important. Supporting them and exiting them is really important. Part of that triangle is that those great founders, and there's only so many of them, so we don't want to dilute our portfolio performance by over investing, but we're seeing more and more, each of these pitch days we see there's more great companies, and we're taking more through to DD. So slowly our rate of deployment will pick up, and also our ticket size, which is kind of, it's not an inflation thing. It's just actually as more investors back us, see our performance and want to put money in, then we then have the ability to deploy larger tickets. We've traditionally done quite small tickets, 150,000. This year we'll be up to about 250, 300,000 by the end of the year. Yeah, so I think that's the kind of, so those two things, rate of deployment, and actually seeing, seeing these companies, the companies in our portfolio, like bed down more IP, internationalize, and start to get acquired earlier than we'd expect. All of those things are kind of happening. And I put it down to a big part of it, right, which is relevant to this conversation. A big part of it is because they're, it brings challenges with it as well. But the big part is because they're engineers. They're pretty modest, right? And they're generally quite modest, and they really they want to solve a problem. They're not sort of technologists that have created a solution and want to find a problem. Like, they're engineers that are really, really bugged by a problem, and then it's a problem that there's profit to be made by solving this. And then it's our job to kind of make sure there's enough cash and clear the runway for them, But so I think that's kind of what to expect from us for the next couple of years.
Brilliant. Well, I'm certainly looking forward to following your progress, and no doubt seeing you at multiple networking events this year.
Absolutely.
I think aside from chancing an encounter at a networking event, a hardware event, how can people get in touch with you? How can they find out more about the British Design Fund and maybe bring in their idea to your table?
Yeah, so really, number one, go to our website, britishdesignfund.co.uk. There's a really simple application form. It's got our criteria on there. Get an application in. That's, no matter how you find us, we'll ask you to do that. That's how you start the process. And to be honest, and then if you're looking to bump into us, we are pretty active. We're out there. We're out with the universities, the makerversities of the world, the incubators, the design agencies. We're pretty, me and certainly a few other of the team, we're generally out kind of preaching preaching about hardware and how to launch it and fund it. So like you say, you're probably going to bump into one of us if you're in that space. Sign up to all the hardware events, and maybe connect with us on LinkedIn. We put a ton of stuff out through social. And it's very rarely us talking about BDF. It's us talking about interesting stuff, hardware stuff.
Yeah, you share the stories of the founders and the technology that they're bringing through. So it's great to see. Damon, it's been an absolute pleasure. Thank you so much for being on the show and joining me. And I'm looking forward to catching up at the next hardware meetup.
Thanks a lot, Chris.
Thank you for tuning in to this episode of Why Design. If you enjoyed this episode, please take a moment to leave a review wherever you're listening. It really helps others discover the podcast. And while you're at it, why not share it with a friend or colleague who'd enjoy it too? If you'd like to stay connected or explore more about the work we're doing at Kodu, feel free to visit teamkodu.com or connect with me, Chris White, on LinkedIn. Thanks again for listening, and I'll see you next time.